Hello and welcome to Stockwatch Live. Now, could the housing market finally be throwing off Brexit worries and getting a spring back in its step at a time of year when business is traditionally buoyant? After house builder Bellway reported strong sales during the February to June period, all eyes will be on what Berkeley Group has to say on Wednesday when it posts its full year results. Back in December, the high-end house builder raised its full year profit guidance by at least 5%, despite reporting a first half profits fall of more than a quarter amid a slowdown in the London and South East housing market. It also said last year's pattern, which saw 55% of profits come in the first 6 months, is likely to happen again. In March, it boosted that profit forecast to 8%, again despite the fact that in the 6 months to the end of October, pre-tax profits fell almost 26% to just over £401 million. The company sold fewer homes, but at an average selling price of £740,000, up from £721,000 a year earlier. Guidance for the next 2 years was unchanged, with pre-tax return on earnings expected to normalise after that to around 15%, based on current market conditions, the company said. While very mindful of the potential for short-term market dislocations from the current political backdrop, we remain steadfast in our belief in the long-term resilience and attraction of our markets of London, Birmingham and the South East, the company said. Brokers generally rate the shares a hold and have a price target of between £32 and £37 on the shares. The only broker to have recently updated its price target is HSBC, which has reiterated its hold rating and raised its price target from £37.80 to £41.30. Now, speaking of high-end products, handbag maker Mulberry has been very quiet of late. So have its shares, which have been hovering around the 280p mark since the start of 2019. But on Wednesday it's due to post full year results. Looking like it's lost its grip on the luxury handbag market, we can expect more of that familiar retail story of falling sales and, in this case, the situation made worse by the collapse of House of Fraser. Its exposure to the UK market has only amplified its problems, with 70% of its sales dependent on the UK. Nascent moves into international markets, particularly in Asia, will most probably prove to have been too little too late. Global digital sales, which represent around 17% of total sales, are unlikely to do much for its bottom line either. Meanwhile, Dixon's car phone bosses are probably wishing things were a little quieter in its neck of the woods. Whistleblowing complaints have led to Carphone Warehouse landing one of the UK financial regulator's biggest fines of the year after the mobile phone retailer missold its Geek Squad insurance and technical support product. The Financial Conduct Authority levied a £29.1 million fine on Carphone Warehouse, part of the merged Dixon's Carphone electronics retailer, after finding staff were trained more in countering customer objections. And it's not the first time Carphone Warehouse has been caught out by the city regulator for mis-selling insurance products. The FCA's predecessor, the Financial Services Authority, fined Carphone Warehouse £245,000 in 2006 for selling insurance without fully explaining the necessary information. It pledged at the time to overhaul its compliance and sales reinsurance. This time it didn't dispute the FCA's findings, which led to a 30% reduction in the fine, which was originally set at £41.6 million. But Dixon said the £29 million it does have to pay won't affect the guidance it gave in a trading update in January, as it had already made a provision for it in its interim financial statement. Broker Goldman Sachs remains neutral on the stock and has cut its price target from 155 to 148p. Barclays Capital is more bullish, initiating coverage of the stock with an overweight investment rating and price target of 175p. So far, generally, the standout winners in the retail route have tended to be either the budget options with cheap prices that have clearly appealed to cash-conscious consumers, and at the other end, niche specialist retailers with loyal devotees prepared to pay for little luxuries. Presumably, though, Bon Marché doesn't fall firmly enough into either camp to please its customers, because trading deteriorated last year, leading to a warning in December that conditions on high streets were significantly worse than during the global financial crisis in 2008. Last month, the company warned that pre-tax losses for this year would be larger than expected after sales weakened further during March. Its shares have fallen by more than 83% over the past year. The women's wear retailer, which operates more than 300 stores and concessions, floated on the alternative investment market at 200p a share in 2013 and moved to a full listing 2 years later. Now it looks set to become the latest small listed retailer to be taken over by a larger rival, after retail entrepreneur Philip Day snapped up more than half the shares and made a cut price bid for the remainder. However, Bon Marché has urged its shareholders to reject the 11.44 a share takeover bid, saying it materially undervalues the company. Philip Day, incidentally, made his fortune with Edinburgh Woolen Mill and also controls Peacocks, another value retailer that owned Bon Marché until it went into administration itself in 2012. But seeing companies being snapped up by their larger rivals is commonplace these days. Athleisure and footwear specialist Foot Asylum, which had also warned on profits several times over the past year, agreed to a takeover by larger rival JD Sports. The 82.5p bid price was at a 77% premium to the market, but still half the 164 pence at which the shares were priced when Foot Asylum floated in November 2017. And that's all we've got time for this week. To follow the companies as they report in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.